Good afternoon and a warm welcome to everyone. I hope you've been enjoying the session so far. My name is Anjali Shukla and I'm a senior manager on the Policy and Insights team at Economist Impact. And I'm delighted to have you join this session on financing the transition, sponsored by Singapore Management University. And for this panel discussion, I have an esteemed group of speakers that I'd like to now introduce. We have Alexander Bent, managing partner and founder at Undivided Ventures. Welcome, Alexander. We have Atul Jhawar, Head of Sustainable Capital Markets, Asia Pacific at Barclays. Welcome, Atul. And we also have Hao Liang, Associate Professor of Finance and Co-Director of the Singapore Green Finance Center at Singapore Management University. Welcome, Hao. Thank you very much for joining me. And just to provide some context around this discussion, the global transition to net zero requires a whole of economy shift to decarbonize across all sectors. And sustainable finance, which essentially entails finance and investment decisions that support economic growth while also prioritizing environmental, social, and governance, or what we call as ESG factors, is absolutely going to be crucial for governments, organizations, and societies to achieve their net zero targets. Now, galvanizing corporate action takes finance, be it in the form of green bonds, loans, environmental risk assessments, or even insurance to protect investment in new green projects. And if you look at some of the figures, they're absolutely mind-boggling. Over the last 2 years, investors have poured more than $1 trillion into ESG funds. And yet, estimates of the annual outlay needed to reach the transition reach into the trillions of dollars. In fact, an estimate from the OECD suggests that we need to invest $6.9 trillion annually in low-carbon, climate-resilient infrastructure. So against this background, I'd like to start off by asking Atul perhaps, what is the extent of the financing gap, Atul, and are investors sufficiently focused on managing environmental risk and boosting resilience, in your view?
Yeah, first of all, thank you for inviting me to this panel. I think obviously we hear a lot of very big numbers in terms of the financing gap, and I won't second guess the OECD numbers and the UN data on this. I think it's clear that there is a huge opportunity as well as a challenge in terms of meeting the goals that nations have sort of set for themselves over the next 6, 7 years, even if you look at the, say, 2030 targets across the board. What heartens me, in the financial sector is that there's clearly been a dramatic shift in terms of both investor perspectives on this. As you said, the amount of inflows we've seen in ESG funds has been very significant. In Asia, some of our data from Barclays Research suggests that over 60–70% of new fund launches in emerging markets in Asia, in the fixed income space that I'm involved in, have had some sort of an ESG label, ESG overlay on them. So I think from the investor perspective, there's certainly growing interest, and it's no longer a niche sort of discussion, right? It's a very significant discussion across the board. And what I've seen over the last 18, 24 months is that it's moved beyond just the large global fund managers who have obviously taken the lead on some of this several years ago. It's moved on to other asset classes as well, whether it's hedge funds, private equity, family offices. Everyone's sort of talking about this, looking for opportunities to invest in the right sort of structures and right sort of projects. So that's the investor perspective. I think from the corporate sector, it's clearly a journey, and I think different countries are at different levels of sophistication, as we heard from the keynote speaker just a few minutes ago. But I do think Asia is, while it might be, say, a couple of years behind Europe from a regulatory perspective, from the perspective of embedding a lot of these things, it's certainly growing extremely fast, and we are seeing that across the board, whether it's more developed jurisdictions in Asia or developing jurisdictions and everything in the middle. So I think we're definitely in the right path. It's hard to say whether we'll achieve the kind of targets that we've sort of set for ourselves in terms of the financing gap, but I think we're definitely moving in the right path. And not just the economics, but I'm hopeful that technology, the two words that I had chosen in the previous poll were economics and technology, right? I think to some extent, you can't force people to do this. The economics have to work in a sustained way. And I think a big part of that is going to be technological disruption that brings costs down, right? So all of that will hopefully help us reach that financing gap that we talk about.
That's really promising to hear. How do you have any thoughts on this as well?
Also, thanks for inviting me. First, I think different agencies, they have different estimated numbers. I think the $6+ trillion per year that is needed probably covers broader sustainable development goals based on some other estimation. If you just think about climate change targets to reach net zero, that's probably a few $100 billion needed per year. So are investors globally sufficiently motivated? I think to some extent, investors are aware, based on some estimations, by next year we will have more than $50 trillion asset under management globally. That's 1/3 of the total AUM being invested in ESG sustainable finance. But on the other hand, most of those money are passive money, meaning that I buy a green ETF rather than proactively change companies' behavior. Of course, this is not to say passive money is not right, but on the other hand, since this panel is about transition, so a lot of the money is to help the brown business to become greener, to transit, rather than directly just hold green ETF, exchange-traded funds, only focus on green companies. So I think in this regard, the private sector can do better. We know that we have a big financing gap. Currently, most of the money that really drives the transition, they are in the public sector, also some from philanthropy, from foundations. And we also know that most of the capital, they are in the private sector. And so the question is, how do you mobilize those huge amount of private sector capital to close this financing gap? I think there are quite a lot of barriers. For example, from the investor's perspective, profit seeking is still their main goal. So that's why we talk about alignment, right? So how do you align their financial incentives, their return expectation with the target you want to achieve? The other is to convince investors that, with a lot of uncertainty to invest in climate change, in nature, in other, big challenges, how can you still ensure a reasonable return, maybe market return, maybe slightly below market return? So how do you remove the uncertainty part? So that's why we also talk about, blending capital from different sectors, combining both private sector capital with the capital from the public sector and the philanthropy. So I think to summarize, investors are not sufficiently motivated or incentivized, in my opinion. But we also have a lot of mechanisms to align the incentive, and I am personally optimistic about what's going to happen in the next few years in this regard.
That's great to hear. You talked about the private sector, and at this point, I'd actually like to get our audience involved in a quick poll to understand their views from a sector perspective. So a QR code that you see on the screen, I'd request you to use your mobile devices to scan it and key in your answer for the question, which is, which sector do you believe isn't doing enough to finance the transition? And the options are the public sector, the private sector, both, or you're undecided, not sure. Let me see. Oh, wow. So there is quite a bit of pessimism there, but very much aligns with what Atul and Hao mentioned, that both the sectors have some room for improvement, and in particular, the private sector. So that actually brings me to the challenges and barriers that need to be addressed to accelerate financing for the transition. And Alexander, I'd love to come to you to ask that question. What, in your view, are those challenges that need to be unlocked in order to accelerate financing for the net zero transition?
I think Atul and Hao talked about a lot of those challenges already. I think when it comes to the private sector, you're looking at education. I think what we've seen is an increase in the last 24 months of people educating themselves or being educated on where to invest. So I don't know whether quantum of capital is the issue. I think smart capital is the issue. I think that we are going to see major disruptions in this space. But unless you really understand this space, you understand some of the drivers behind climate change, behind industry wanting to get involved in actually mitigating some of this climate change, you're also you're not going to invest in the right space. And so for us, for example, we surround ourselves not with financial analysts in our firm, but actually with people who have technical capabilities. Because I think that we really need to look under the hood at a lot of these different companies to see whether they can actually achieve what they say they're going to achieve. And we've seen over, again, the last 24 months, a definite increase in the amount of education and sophistication that people are looking at where they're looking at investing. So, back in, I think, 2019, HSBC and a lot of other players came out with ESG funds. Now, if you looked under the hood of some of those funds, there would be NPR Corp, there would be, I'm not saying NPR Corp aren't sustainable, I'm just saying that they had an ESG policy. It was not addressing real impact. And so if we're trying to look at addressing climate change, we need to invest in companies and solutions that have a measurable impact in different areas of climate change. And I think that that's super important when you're investing in this sector, is to really understand what are you investing in. ESG, to me, is a reporting mechanism. It isn't necessarily an overall impact focus.
That's a really critical point. You mentioned education. And maybe picking up from that, what are those sustainable strategies and initiatives that companies are looking to finance? And Atul and Alexander, I want to come to both of you to address this question, maybe starting with you, Atul. What particular initiatives are companies looking to finance, and particularly from an Asian perspective?
Yeah, that's a great question. I mean, obviously, huge range of things across different sectors, but maybe just picking on something Alexander said, I fully agree. I mean, banks like ourselves obviously have a certain role to play, but are not the entire solution, clearly. But what we try to do is, to address the impact point, we're trying to sort of develop what we call a green escalator, so to speak, right? So we have a climate tech fund where we invest our own capital in more early stage technologies, whether it's direct climate tech or agri-tech or new energy technologies and so on. Obviously with the idea that over time these companies will grow, they will use more of our services, we'll IPO them, we'll give them access to capital markets to scale up. So I think that whole journey is important, and the starting point at the sort of early stage level is across just a huge range of sectors, right? So your question, we could talk about that for 2 hours probably, but I'd say big picture, it probably makes sense for financial institutions and other investors and policymakers to kind of think across that spectrum. We need to make sure that we're investing enough in technologies that will accelerate this, but also, getting companies to scale, and that's where capital markets come into play in a significant way.
Right. Alexander?
Yeah, I mean, I just wanted to also pick up one point. I think that in investing in this space as well, people get very scared about investing in seed or early stage businesses. But if you're investing in a business that's solving for, let's take decarbonization, in our experiences, the chances are the founder has been working on this solution for many, many years. You don't, roll out of bed and say, I'm going to start a solution that's going to decarbonize the whole built environment. We could start with all due respect, a co-working business tomorrow. We just rent space and we have a co-working company and technology associated with that, and we go out and raise money. I think a lot of these solutions have been thought about for a very long time. And so what our role is helping to commercialize them. And I think that is one of the challenges in this space, is you've got very technical problems and very technical solutions, and those founders often are focused on the technicality, might not be focused on how to get to market. So we talk about some of the stumbling blocks to climate transition, energy transition, etc. I actually think a lot of the time it's not just around capital, it's also around facilitation. And providing those opportunities for these companies to have that first pilot and then get in and move forward.
Right. But in terms of these sustainable strategies and initiatives, I'm curious to understand if you see a trend or a pattern whether they're more focused on mitigation or adaptation. I mean, Asia is pretty much grappling with the both of them, but do you see a clear pattern over there? Maybe any of you can take this question. How, if you would like to take it?
Yeah, so as you said, we probably focus on both
Yeah.
mitigation, adaptation, and that they also speak to whether we care more about the physical risk or the transition risk, right? So physical risk is you are directly hit by climate change impacts, extreme weathers, sea level rise, and transition risk is if we need to reach net zero, a lot of the assets that the business are holding are becoming devalued over time or even turn into liabilities. So I think that's very sector specific. Some sectors, agriculture or food related sectors, maybe for them it's more about mitigate the physical risk from climate change, whereas other sectors, those carbon intensive sectors, they are the contributors to climate change. So for them, it's mostly the transition risk, how they decarbonize, and coming back to the earlier question about what kind of strategies, right? How they not just only invest in new technologies, including renewable energies or CCUS, carbon capture, utilization, storage, but also how they raise funds from for those investments. Then we are speaking on the investor side. Which type of investors, banks, asset managers, they care most about their physical risk exposure, and which kind of investors they care more about transition risk exposure. So that's also sector and investor specific.
Understood.
Maybe
And
I can just
yeah,
jump in
sure.
there with one comment from sort of personal experience. I think that focus sort of depends a little bit on where in the world you are. So I live in Singapore. It's obviously a small nation, and even if we change our fuel mix dramatically over the next 20, 30 years, it's not going to have a huge impact on emissions globally. But on the other hand, Singapore can certainly be a leader in terms of mitigation technologies and mitigation approaches. And we're going to be one of the first to sort of see the impact of rising sea levels, for example. And Singapore's developed a very long-term plan to sort of deal with that, and just at the early stages. So I think that sort of depends a little bit. Obviously, larger countries like India and China, there's going to be elements of both. They can obviously make a huge impact if they, from a mitigation perspective, but also certainly will be exposed to physical risks over time.
Right. So
That
what?
sorry to interrupt. I think that locality is very important because I think that whether you're looking at climate mitigation or climate adaptation, I think Asia provides one of the biggest opportunities just in terms of commercial rollout for climate adaptation technologies, right? And I'll give you an example. In the real estate sector, I'm based in Hong Kong. Everyone's looking at decarbonization technologies and SaaS solutions, and in the building sector, and it's all rather boring. But that's what they're looking for. As soon as we had 3 typhoons in a row, as soon as buildings started to get damaged, I got calls from developers asking, have you got anything around climate adaptation? This is a word I've just discovered. They said, have you got anything around climate adaptation? So I think it comes back to that commercial driver that we're talking about and actually physically seeing that change. I think, we walk around cities all day long and we don't actually see in our day-to-day any kind of change due to climate change. But when it does happen, that wakes people up. And I think also in Asia, when you're looking at cooling technologies, for example, I think that provides an incredible opportunity as well around climate adaptation. Yeah.
Absolutely. Rising heat stress is very much a critical issue in the region. And it makes sense. I mean, it's really a region and sector specific, preference of whether you go for mitigation or adaptation technologies. And in that sense, the Asian region is like a real-time experiment because of its sheer diversity. I do want to focus a little bit on the role of regulation as well, and in particular, ESG regulation. I mean, in recent times, there has been a wave of new ESG-related reporting regulations, such as the Corporate Sustainability Reporting Directive. And if you read into the fine print of these regulations, you can see that they underscore a clear departure from companies merely securing positive ESG ratings to actually moving to take tangible, accountable actions. And this regulatory shift also necessitates proactive adaptations on the part of various actors, be it investors themselves, be it the corporate sector, or even the ESG ratings companies themselves. So maybe I want to come to you to ask, how are investors working to align to these plethora of new ESG regulations?
Yeah, first, there are a lot of regulations, a lot of standards out there
Yes.
that creates a lot of confusion for investors. I think the positive thing we are seeing is there's a consolidation of disclosure frameworks. And I think speaking in this region, we are mostly talking about ISSB, International Sustainability Standard Board. For a long period of time, disclosure, mandatory disclosure is mostly about carbon disclosure. Of course, with ISSB, it's more, ESG on much broader range. Whereas in EU, they already have their, CSRD, SFDR, a lot of acronyms. I'm still trying to get familiarized with all of them. So that's a burden for many business. And of course, this burden also becomes driving force for companies to change. Some companies they couldn't live up with the cost. Many of them they even die. Other companies they become more efficient and invest heavily in renewable energy, new technology. But I think what's important is the clarity of all these regulations, especially what you need to disclose and what qualifies as green and what qualifies as transition. Transition finance, I think disclosure, regulation and disclosure on transition finance is a good example. For a long period of time, we know that we have EU taxonomy telling us what is green, what is not green, and then you can't call yourself a green company or green fund if you don't check enough boxes on the EU taxonomy. But when it comes to transition finance, when investors, banks, they began to provide financing for brown business, then there's a lot of room for greenwashing, right? So yeah, it doesn't check the green taxonomy boxes, but then because we are helping them to transit. So I think there's a huge need to have more nuanced classification on those kind of activities, right? So transition activities. One advancement that we saw last year, for example, the two central banks in Singapore and China, they established this working group to develop taxonomies for Asia, for green as well as for transition. So I think that's a bright side on this movement. But I mean, Asia is not a one entity, so we have so much variations, differences, and what is considered as transition may not apply to another country, to another industry. Clean coal, do you call this transition? I think this is still debatable. On one hand, it's clean, but on the other hand, it's coal, so it contributes to climate change. So I think this is just one example of how challenging it is, but I think that's a step we must take.
Clean coal is a very interesting term, but education, as Alexander mentioned, is also going to be very critical for everyone to get up to speed with the new regulations.
Yeah, so on that point, yeah, indeed, I completely agree, and I think that's the advantage of a university and me as a faculty to really educate people, what's the difference between green and finance, and how do you actually think about transition, think about taxonomy, and think about all these ratings. And certainly we also need inputs from the industry. So, and I think SMU and together with many other universities, we play an important role.
Absolutely. And Atul, maybe quickly coming over to you, the same point around how investors are aligning themselves to these new regulations. Do you see any change or any evolution there?
Yeah, as you rightly said, it's proliferated so much, and it's sometimes hard to discern whether it's creating more confusion than breaking down barriers. I'm personally on the camp that regulation should be done in a very measured and careful way, and it's easy to over-regulate without being cognizant of market forces. So just as a hypothetical example, you could ban combustion engine cars by 2030 or something like that, but if you don't have the right sort of plan to get there, in terms of the economics of, rebuilding an EV infrastructure, it's not going to happen, right? So I think regulation should be done in a way that's really just trying to facilitate the market forces in the right way. And taxonomies are a good example of that. I think it does allow capital to flow in an easier way, I think, if you've got the right acceptance of taxonomies globally and there's enough alignment.
Yeah.
I think the transition taxonomy point is very interesting because, and that's where maybe I can give the sort of private sector perspective. There's, to some extent, I think you can't just wait for regulators to come up with a taxonomy that everybody agrees on. So, for example, recently, just a couple of months ago, Barclays published its transition finance framework, which is a supplement to our sustainable finance framework, which we had published a few years ago. And as you rightly said, it's extremely nuanced. It's a much more complicated document. It has 100 plus different specific types of technologies in different sectors that we would consider to be suitable and what the checks and balances would be and all of that. So it's much more complicated than a green finance framework. But if banks do that, for example, and get the right amount of alignment from large investors globally, then that can start to create more capital flows and more transactions that everyone agrees is robust enough from a transition finance perspective, is going into the right technologies, has enough checks and balances to manage greenwashing risk and so on. So yeah, there's a role for private sector to play there as well when you talk about regulation in the broadest sense.
Right. Thank you, Atul. And speaking of regulation, you mentioned that regulation should be just right and not too much. I do want to finally focus a little bit on the role of the of the public sector. Fossil fuel subsidies are considered as a key barrier in enabling that net zero transition. So Alexander, maybe coming to you, what measures do you think are needed to redirect those subsidies from fossil fuels to renewable sources of energy and clean fuels?
I think it's all economics. Really, I mean, I think that, I deal in the built environment, so I deal with construction companies, real estate companies, infrastructure companies, whatever their website says, none of them are going to do or employ a sustainable solution out of the kindness of their heart. They're going to do it because it has a measured financial payback, either with their bottom line or helping to add value to their business. So I think that, over time, we need to understand, someone had a keynote just earlier who said that we need to get away from this idea that sustainability is expensive. Sustainability for me in the industry I deal in is all about efficiency. And, I don't believe that in 10, 15 years' time, you're going to see any impact funds and you're going to see any, we might not be here having a sustainability discussion, because if you're not a business that employs efficiency, you're not a business that understands some of the impacts on your own surrounding environment, you're not going to be in business. And that's either going to come down to banks who may not give you debt financing, investors who probably won't invest in you, and also just the general consumer, who, again, in my industry, might not buy your apartment, might not go and rent an office space from you, and may not rent your retail. So I think all of this transition, to me, is purely about economics. And if we can find those right, motivations, then I think it could actually speed up the process.
Economics and education.
Education, yes.
Thank you very much, Alexander. I do want to leave a little bit of time for questions from the audience as well. So we do have microphone runners who will take questions from the floor. So if you wish to ask a question, please just raise your hand and someone will attend to you for any of our speakers. Yes, please. Go ahead. Please introduce yourself as well.
I'm Sultan Zaleh. I'm from Prime Coalition, a US-based firm. I know you're talking a lot about the economics of things being a driving force, but I'm wondering what your opinions are on alternative models such as impacts-linked compensation, which is sort of the amount of capital going towards a given solution is proportional to its verifiable GHG impact and less focused on traditional models such as evaluation or things like that. Thank you.
Who would prefer to take this question? How?
Yeah, perhaps I can give some of my thoughts. First, I think we never get rid of the economics, right? So we all, even after more than 50 years, we still talk about Friedman, Milton Friedman, the business of business is business. And whenever you stop talking about business and begin to talk about compassion, then business people run away. So I think we still need to talk about financial return. And of course, we today also talk about impact. I think one, movement or one trend, emerging trend, is to how you monetize impact. So how do you actually put monetary value onto impact? And because for many investors, not everybody, realistically speaking, not everybody only go for the financial return and totally forget about impacts. We are okay to talk about impact as long as you ensure financial return is realized. But then I want to know how much impact I create and how do I compare that with my financial return. So there are a lot of advancement in this space, for example, value balancing alliance, nature capital protocol. All these are about how to put a dollar value on the impact such that the investor can compare it with the financial return. And there is also this thing called impact accounting or impact statement. Many companies, they are no longer happy with only having an ESG or sustainability report. They want to put the natural social impact in dollar amounts into their balance sheet, into their profit and loss statement. And this is actually one of the research projects that SMU, in our Singapore Green Finance Center, we are also actively looking at and happy to, and this is a huge conversation, happy to talk about this offline afterwards.
Great, thank you. Thank you, Hao. Is there any other question? Yes, please, go ahead.
Hi, this is Shirley from Provec International. We run the first incubator focusing on animal-free food techs. My question is, what are the lessons can be learned from the past sustainable financing, from successful or not so successful sustainable financing initiatives? Thank you.
What are some of the successes? Atul, would you like to take this?
It's a great question. I think obviously the industry has gone through starts and stops, and certain parts of it have become scalable, whereas certain other parts have struggled to find traction in at least certain markets. So maybe I'll just talk about sort of a example in terms of my business. A lot of what we do is underwriting debt transactions for companies in various flavors of ESG labels, right? So green bonds, sustainability-linked bonds, and so on. I think green bonds have generally become a success story. We've had enough global acceptance. Everybody kind of agrees on. I think we've moved away for the most part about whether clean coal is a green instrument or not. A green asset or not, for example. But on the other hand, there are more nuanced parts of the market, like sustainability-linked bonds. We've seen it take off very, very well in the European markets, but not as much in the US and Asia yet. I think Asia is probably going to get there to some extent with some evolution of how the structures work. There's still a lot of debate about whether things like the penalties are meaningful enough, whether the targets are ambitious enough. So there's much more work to be done there. And I think the clearest example that you talked about is transition finance. There's almost no agreement right now in terms of what constitutes transition finance, except for the easiest of use cases. And that remains to be seen, I think, whether it'll be a success story or not. But it's an important one, clearly.
Thank you, and I hope that answers your question. As much as I'd love to continue this discussion, we are at time, so I'll now wrap up. Thank you so much, gentlemen, for the insightful discussion. We went over a number of pertinent themes as part of the net zero transition from, talking about how there is a growing interest in investors and in different types of sustainable and transition finance, but then there's also some steps to walk when it comes to accelerating financing, especially from the private sector. We also talked about the role of ESG regulation. We talked about the different types of strategies and initiatives that companies are looking to finance, and we finally also talked about the role of the public sector. So thank you very much once again.